Good morning, everyone, and welcome to the second of RSM's online practitioner support webinars. It's great to see so many of you have signed up today and are all logging in this morning. I'm sure it's going to be another excellent session. For those of you who don't know me, I'm Justin Stevenson, an Associate Director in the Tax Investigations team here at RSM. And today I will be introducing you all to our speakers. And then I'll be back at the end of the session to host a Q&A on what we've been discussing. We really have pulled out all of the stops today with our speakers, and each of them really are leading experts in their fields. And first up, we'll have James Hawksworth. And James is an insolvency practitioner and director in our Restructuring Advisory team. He currently looks after the teams in our Reading, Basingstoke, Bristol and Swindon offices. So James will be talking you through today some important changes in the insolvency legislation over the last 6 months and how this will impact your clients. Next up, we will have another James Tetley. James is a corporate tax partner and based in our Southampton office. And what James will be chatting you through is how cash can be claimed back via tax reliefs and, of course, tax deferrals as well. That really is going to be important in the current economic climate, with cash flow really being massively important to all of your clients and their businesses. Finally, I'm very pleased to be able to introduce you all to Andrew Timpson. Andrew has recently joined the firm as a partner in our Employer Solutions team and covering the Southern region. And he's going to be talking us through some topical beyond furlough employment tax issues, including IR35 changes, redundancy payments, and remote workers. So, as you can see, we've got loads of really interesting content to cover for you this morning. The presentation should last roughly 40 minutes, then I'll be hosting the Q&A session, and we're aiming to finish for around 10 a.m. Please do use the Q&A box on the bottom right-hand side as we go along. Type in any questions you have there for any of our speakers. I'll be monitoring these as we go through the presentation. And please don't be shy. Only us panelists will be able to see what's typed into that box. So please do put any questions you have there. And finally, the last thing to say is that all attendees' mics and cameras have been muted, so please do not worry. Feel free to crunch on your cornflakes and slurp your coffee as we go along. And on that note, I shall hand over to you, James. Thank you very much.
Good morning, all. So I first wanted to touch upon tax deferrals and the time to pay arrangements. As many of you will be aware, earlier in the year, HMRC offered deferrals for VAT under a specific scheme, but also a more general deferral for other taxes for the period from March through to September. These are now coming to an end, and HMRC are expecting businesses to contact them to put in place more formal time to pay arrangements. It's early days, but we're seeing HMRC take quite a robust stance for any applications to pay instalments over longer than 12 months. And they do expect to see evidence that this is a last resort. For example, banks, you need to be able to demonstrate that banks have been approached for additional funding. Shareholders have similarly been approached for additional support before then finalising a proposal to HMRC. That being said, with the appropriate evidence, it is possible. I would also add, care is also needed where a business may be expecting refunds in that time to pay period. A common example is R&D tax credit repayments. Businesses will find that these are automatically offset against the time to pay liability. So when preparing cash flow projections, this is important to bear in mind. Now, if we move on to the next slide, corporation tax relief and specifically areas where businesses can unlock cash through tax. Now, firstly, if businesses pay corporation tax by quarterly instalments, then the likelihood, or certainly the chances are, that they may have overpaid. Earlier forecast profitability may now have reduced, and we may now be looking at a profit that's significantly lower. If this is the case, simply write to HMRC and request that the overpayments are repaid, and we've seen that HMRC have been very amenable to processing these requests. Similarly, if HMRC are holding cash on account, for example, an overpayment from a previous period, rolled into a future one, again, these amounts can be reclaimed. Going on from that, if a company were profitable in the previous year, but will make a loss in this year, then the sooner they finalise their current accounts, the quicker they can make what's called a loss carryback claim to carry the loss in the current year back to a previous year's profit and unlock that repayable tax from the previous year. A slightly more drastic option, but nevertheless possible, is to potentially move a company's year end forward to accelerate that process of accounts finalisation and that loss carryback claim. And finally, companies can also review prudent approaches around, for example, provisions, legal and professional costs, and capital expenditure. You often find that with a more detailed review, additional deductible costs can be identified that may have been overlooked the first time around. And then if we move on to the next slide, there's a few specific tax reliefs that are worth a closer look at the moment. R&D tax claims generate repayable cash, typically between 10 and 33p per pound spent, depending on which scheme you're claiming under. HMRC continues to be very supportive, repaying claims within 28 days of submission, and now's definitely a time to make sure that these are being maximised. A couple of words of caution. A claim does need to be supported by signed accounts, and those signed accounts need to be on a going concern basis. And this is where we've seen some delays and issues where, for example, audits have not been signed off subject to a going concern review given the recent months. Claims need to be filed on time. There's still no excuse for lateness. And also a significant area of complexity here is around grant funding and government-backed loan schemes and how that interacts with the SME R&D tax credit scheme. Now, bounce-back loans, C-bills and CL bills are all what's known as notifiable state aid, as is the SME tax credit itself. And you can only have one notifiable state aid for any project. So when preparing these claims, it's important to note whether a business has obtained funding through these methods, and then to take appropriate advice to make sure that a claim is still appropriate under the SME scheme. And finally, on R&D, there's complexity over how to deal with furloughed employees when preparing more recent claims, and HMRC have recently issued guidance on how to deal with them. Moving on from R&D, we also have the patent box, which is a 10% rate of corporation tax. Sorry, just slip back to the previous slide for a moment. So we have the patent box, which is a 10% rate of corporation tax. And there's a possibility here to refile your tax return and obtain that repayment of difference between the 19% main rate of corporation tax and the 10% patent box rate. This will be relevant to any profitable business that has patented technology or patents that it's exploiting. And then we have other creative sector tax reliefs. Some of these are a little bit more niche, but still relevant in the right circumstances and typically generate 20% cashback. We have video games tax reliefs, film tax relief, animation tax relief, theatre tax relief, orchestra tax relief, and museums and galleries exhibition tax relief. As I say, very, very case specific, but nevertheless, with the right fact pattern, these are very relevant. Capital allowances, one of the most commonly known tax reliefs, but often the reason why it's underclaimed. It's also a very flexible tax relief in that if the relief hasn't been claimed, it's still on the table to be claimed, irrespective of timing limits. And again, this can increase tax relief and indeed generate a tax repayment. Within capital allowances, we have R&D capital allowances, which generate 100% relief. We have our annual investment allowance, which will be $1 million until 31st of December this year. And we also saw the structures and buildings allowances introduced from April at 3%. I think the key takeaway here is to review historic expenditure. And I'll just give one example of a business we worked with a couple of months ago, a medium-sized pub chain, and 2 weeks before their year end, we were engaged to review their portfolio. Within that space of 2 weeks, we've unlocked £60,000 of extra cash back, which eliminated that business's liability for the year and was most welcome, given, again, the past few months' challenges. On the subject of property again, land remediation relief. Again, quite case specific, but nevertheless relevant in the right circumstances. If a business is occupying contaminated land from industrial use, and that contamination didn't arise from the company's own doing, then there's the opportunity to claim 130% tax relief or a 14.5% cash back for the remediation work. And if we move finally on to VAT and some specific VAT challenges and opportunities here, we start with the deferral scheme and specifically the bad debt relief block. So if VAT was charged on an invoice, the payment of the output tax on that invoice was deferred under the government scheme, i.e. not under a time to pay, then you can't claim bad debt relief if the customer doesn't pay within 6 months of the due date. Then looking at the VAT temporary reduced rate, and specifically here credit notes for deposits. If, for example, you paid a deposit for an August hotel stay in January, then VAT at 20% was charged. You're entitled to treat this deposit as being subject to the reduced rate if certain conditions are met, although if you raised a VAT invoice, then you may be out of time. Turning to vouchers, the introduction of the reduced rate could change the VAT accounting required for some vouchers. And then the Eat Out to Help Out scheme and VAT brought complexity as well. VAT is typically due on Rish's contribution to the meal, but the VAT treatment of obligatory service charges still remains unclear as to whether that's standard rate or reduced rate. Looking forward and away from specific COVID challenges, Brexit's still coming. The only thing that's changed is that businesses have been distracted for the last 6 months in other directions, and a recent survey from the IOD highlighted that only a quarter of businesses are ready for Brexit on the 1st of January 2021. I'd hope this is fairly self-explanatory, but if you trade with the EU, then you may be affected, and businesses are certainly running out of time to put the appropriate preparation in place. And a couple of other points on the horizon. We have a next stage of making tax digital for VAT, and specifically digital links from 1st of April 2021. If your VAT return information is derived from different sources, for example, EPOS reports, purchase ledger, staff expense software, then the information must be digitally linked to the submission software. Copy and paste or transposing data manually will not be permitted. And finally on VAT, we have construction services and VAT. The domestic reverse charge is due to come into effect from the 1st of March 2021, as many will be aware, delayed from last year. Specifically, subcontractors covered by CIS will no longer be obliged to charge VAT to the main contractor, provided it's VAT registered. Now, this is likely to give rise to significant negative cash flow issues, additional record keeping requirements, and again, it's going to be key that the businesses prepare for this as soon as possible. There's a lot of opportunities in here to unlock tax relief, but there are some pitfalls for the unwary, and certainly across the board a lot to think about. I'm going to hand you across to Andrew now to talk a little bit more around employment taxes.
Thank you, James. Good morning, everybody. I'm going to spend the next 10 minutes or so talking about beyond furlough arrangements in 3 particular areas: off-payroll working, CR35 position, redundancy and termination payments, and remote workers. So off-payroll workers, IR35 protection will be abolished from April 2021. Finance bill was signed on the 22nd of July. There will be no postponements beyond April 2021. Some of your clients may well be exempt. Small companies are exempt from the position. The Companies Act has the definition at 382. In short, turnover is not more than 10.2 million, assets of not more than 5.1 million, and employees of not more than 50. Any of your clients with 2 or more of those will be not considered small, and therefore will be considered medium to large and within the new off-payroll working rules. The rules will command that status assessments will need to be done and will be mandatory for all off-payroll workers that are engaged through intermediaries. Intermediaries, the most common ones are limited companies, personal service companies, but they can also include partnerships and other entities. So check with your clients that they understand that position of what an intermediary is. Audit trails will be needed. Records must be kept for 2 reasons. 1, HMRC will be doing reviews. They will be doing compliance reviews specifically on off-payroll workers. And 2, there is a contractor disagreement process that can be applied as well. We'll come on to that a bit later. Status determination statement. So once an assessment has been concluded, your clients will need to prepare a status determination statement and provide that to both the fee payer and the individual. The fee payer may not be your client, it could be an agency, and if it's a complicated supply chain, it could be many agencies within the chain. They all have to receive a status determination statement. It's a bit like a receipt or a voucher. One of the things that's needed is the reason for the status conclusion. If the reason is not included, it will not be valid, and therefore non-compliance will ensue. Client disagreement processes, so contractors can disagree on the status that has been determined. If that is the case, your clients need to have a process for dealing with that disagreement, and your clients will have 45 days to respond to any contractor that has disagreed with their concluded status. Unfortunately, there is no deadline or timeline for the contractors to submit their disagreements. So as a result, it can be day 1, it can be day 30 or day 100 of any contractual period. COVID-19 pandemic, interesting one here. At the end of 2019, many of my clients were deciding not to engage off-payroll workers because of the compliance hassle, and they can see that all of the tax and social security and national insurance charges will go on to them. Given the situation we're in now with the pandemic, many of those clients are changing their mind. They want fluidity within their workforces, therefore off-payroll is becoming more attractive. Again, a good talking point with your clients if you want to have a conversation with them around this matter. And finally, on this one, HMRC activity, we're lucky enough to have a webinar last week hosted with HMRC. They were giving away some of their insights. Top 2 reviews will happen, I've already said that, but it will be a light touch compliance. Light touch means penalties will apply, but only where it's considered not careless. Not careless being deliberate or deliberate with concealment. Therefore, if your clients are assessing and have processes in place, a light touch will apply to them. Moving forward to termination payments. So many employees have been put on furlough. If they are being made redundant, they can remain on furlough during their notice period, but they are entitled to 100% of their pay, not the reduced 80% of furlough payments that the government have been making. One that is tripping up clients, so please check with your clients if they're making redundancy payments. Furlough bonuses will not be paid if any employee is working their notice period. So the government is providing £1,000 furlough bonus where employees are successfully returning after the furlough period. It's a 3-month period to January 2021. If employees are working their notice, they will not get the bonus for that employee. So there's a planning opportunity here for your clients to consider when redundancy is going to be most effective. Post-employment notice pay, or PEMP, it's the most significant change in legislation around termination payments in a couple of decades. It's trying to replace and tackle the pain of notice ambiguity around whether it should be taxable, whether it shouldn't. This cuts across all of that and effectively says it is. The reason why it's the biggest change is because there is a formula or calculation that is mandatory. Not many employers know this or getting this. The more they speak to, the more they just aren't aware of it. It is mandatory for them to make a calculation to understand what the post-employment notice pay is, and where it's identified, that is a subject to tax and national insurance payment. There is no get out. It's a payroll payment that has to go through tax and national insurance. Class 1A national insurance, another change, but it came in April 2020, so it may go under the radar given where we've been over the last few months. It's been mooted for a couple of years. It's a social security on payments above £30,000. So ordinarily the compensation payments that meet the 30,000 tax exemption. It's taxable over 30,000. There is now a national insurance charge over that 30,000. It's a payroll withholding. Even though it's class 1A and that normally only applies to P11Ds, this is a payroll withholding with an employer-only charge, but it does not apply to an employee charge. So your clients need to have their payroll software updated, make sure that that is valid, and wage types are implemented with a new tax and NIC flag for everything over £30,000. One, again, to touch base with. Remote workers, during the last few months, remote working has become normal, or has become the norm. I know offices are opening up, but it's not on a full-time basis. A couple of points for remote workers to get some exemptions from tax here. There has to be a requirement or necessity by the employer to have employees working from home. It can't just be an informal thing. The pandemic has allowed the necessity, but if we're thinking beyond this, then we need to really think about having a home working policy that is exacting and fit for purpose. Equipment and allowance, with some extensions to tax exemptions that's come about because of the pandemic. Equipment provided by the employer ordinarily is tax free. There are some business and private use, we'll just come on to that in a moment. But ordinarily any cost reimbursed to an employee for furnishings or equipment outside of the pandemic would be subject to tax and national insurance. Not many people know that, and it's quite, and I know it's been quite prevalent from the conversation I've had with clients. The COVID pandemic has allowed, the revenue have allowed the extension to now reimbursed costs. There is a timeline on this. The timeline is up to the 5th of April 2021. Beyond that, there's been no extension at the moment. So it will revert to taxable beyond that. If your clients are reimbursing, have a conversation. It may well be a PSA or something on the other side. Business and private use, ordinarily not a problem. But given that many clients, employees have been working from home and they've had homeschooling of their children, equipment may be used for different purposes. The revenue will check this, they confirm that, so please just raise that with your clients to make sure they're aware. And finally on this one, the home working allowance, employers are able to provide £6 per week to employees who are working from home, again, 2 words that are required, and it's a necessity for them to work from home. Again, the COVID pandemic have allowed that criteria to be met, but beyond the 5th of April, it may well be that we need to consider that position, and a home working policy will obviously make that work for them. Overseas, one that's not really come up in the past, but overseas remote working during the pandemic has risen, significantly risen. And there are 2 positions here. Some employees are just stretching the term home, speaking to clients and asking them, do you have anybody that's going overseas? And they say no. They've checked it and said yes, they have, because home is actually not in the UK, it's overseas. That's causing and creating many issues for employers. The other one is where they've allowed informally for their employees to go overseas at the beginning of the pandemic, and they haven't checked in since. Short term should not ordinarily be a problem. We're now approaching and over the 6-month mark. That creates payroll withholding taxes in many jurisdictions around the world. Also social security charges where you don't have the appropriate certificates of coverage or A1s. Note of caution on the A1, anything beyond the 31st of December 2020 could inadvertently bring you into double social security charges cross-border on the basis of we are Brexiting, and as a result we are losing some of the A1 powers around social security. And the big one that many clients do not want to have is the creation of a permanent establishment. Activity will denote this. Sales is a big one, but also if you've got senior people in jurisdictions, it could always create a risk of permanent establishment. One to really consider. So, IR35, make sure your clients have got a process in place and they're working towards the April deadline. Redundancies, post-employment notice pay, check that off with them. And remote workers overseas, really consider whether your clients have got a concern. Thank you. I can now hand over to James.
Good morning, everyone. Thanks for joining us. I'll be talking to you about the restructuring and insolvency legislation contained in the snappily titled Corporate Insolvency and Governance Act 2020, and also be touching on the Finance Act 2020, as you can see on the slide. Now, unlike a lot of you on the webinar, I'm not a lawyer, so I'll just be giving an overview of the practical and the pragmatic implications of the legislation and how I think it might impact businesses and their stakeholders. I cover quite a lot of ground in the presentation, so it's quite high level. So if anybody wants to discuss any of the matters in more detail, do just drop me an email and I'll be happy to arrange a call. So if we move on to the next slide, start with the moratorium. So this kicked in June 2020. It's a procedure which can be used only when there's a belief that it will facilitate the rescue of the company as a going concern, not just a rescue of the underlying business, but of the whole company. So the directors remain in control of the company during the moratorium, but there's legal oversight from someone called a monitor, which is effectively an insolvency practitioner who's having a look to see how the matter's progressing. And the monitor can terminate the moratorium and is obliged to terminate the moratorium if a rescue looks like it's no longer likely. So what is a moratorium? Well, basically it protects a company from legal actions being taken against it by creditors and prevents it from being wound up as well by creditors or taken to court and similar actions. So over on the next slide, we can see an outline. So this, as mentioned, can only be used when there's a belief that it will rescue the company as a going concern. And the insolvency practitioner has to put their name to that in documents filed at court. So that makes it more onerous for the IP. They really put their credibility at stake and they risk censure if it fails. And it's riskier for the IP because the business is actually still being controlled by the directors, so it needs a lot of planning. So the moratorium lasts for 20 business days initially, can be extended for a further 20 without creditor approval. Creditors can then vote to extend it for out to a year, and a court can extend it indefinitely until it reaches its natural resolution. And its resolution should be that it meets a consensual solution with creditors, possibly a company voluntary arrangement, which is an agreement with creditors, or a restructuring plan, as we'll come on to later. Anything owed to creditors before the moratorium does not need to be settled within the moratorium. So those amounts can be put to one side. That's with the exception of wages and financial services amounts, such as loans falling due within the moratorium period. But all costs incurred during the moratorium must be paid in full. So the costs which are incurred during that period are given super priority status, regardless of whether the moratorium succeeds or fails. So on the next slide, I give you a sense of what the super priority status means in practice. So super priority creditors need to be paid in full, even if there's a successful exit via CVA or a restructuring plan. But if the company fails within 12 weeks of the moratorium, 12 weeks of the end of the moratorium, all moratorium debts are bumped up the priority list in the resulting insolvency and get paid from floating charge realisations ahead of secured floating charge creditors and unsecured creditors, as you can see on this slide. So this priority treatment should result in creditors, employees and lenders having far more confidence with continuing to work with a company in moratorium. But it also means that if the moratorium fails, that secured lenders and creditors with pre-moratorium liabilities on a failure are likely to suffer a far greater loss than they would have done if the moratorium simply hadn't happened and the company had gone straight into insolvency. So on the next slide, the key issues for creditors: no notice is required to be given, but because the monitor needs to put his name to his belief that the company can be rescued, they will need confidence that funding will be available and that key supplies will continue to be supplied. So one would hope a responsible insolvency practitioner in the role of monitor would consult with lenders and key creditors before commencing the moratorium. The consent of the courts required to allow secured creditors to enforce their charge and place it in insolvency, but if their contractual lending terms allow it, lenders can accelerate their debt to be immediately payable. So they can say all sums are due right now, and that means that the monitor is very likely to need to end the moratorium because a rescue would not be considered possible at that point. So clearly, if the moratorium fails, the asset base of the company is worsened and old creditor debts will be paid behind moratorium debts, meaning possibly a far worse outcome for pre-moratorium creditors. So how can the risk of insolvency practitioners signing off badly thought through moratoriums which are bound for failure be avoided? So that will really need to come down to censure of monitors who sign off mistakenly in a belief that a rescue is possible. It's not entirely clear how that will be policed, but they will be closely regulated by their governing bodies. They could potentially lose their license, and there's of course a risk that creditors could head off to court if they feel the monitor's actions has unreasonably caused them loss. So that's really the moratorium. The next slide talks about the corporate restructuring plan. So this is again came into force in June. It's court and lawyer driven. It doesn't need to be led by an insolvency practitioner. The company has to be distressed to go into this process. And the application can be made by the parties you can see on the slide. The plan is essentially a compromise or arrangement proposal put to creditors and potentially shareholders to resolve complex distressed issues. And you can see the steps in the process on the next slide. So the plan itself needs to be just and equitable, and it gets submitted to court with details of the way the stakeholders are going to be split into separate classes. And I'll talk a bit more about that later. At the hearing, a court considers the plan and the composition of these classes and then sanctions whether or not a vote can take place. The vote takes place at step 3, and then a second hearing takes place, and the court decides whether to implement the proposals, including any cram down or cram up, which I'll talk about later. And the plan then commences by court order, which is filed at Companies House. So on the next slide, we talk around the key points of the restructuring plan. So the directors remain in control, much like in the moratorium, but there is no moratorium. So it may well be used in the future in conjunction with the moratorium process we mentioned earlier. The plan is expected to split creditors and shareholders into various classes depending on their financial interest, with each class potentially being treated differently in the plan. So each class is given a vote, and if 75% of each class vote in favour, that means it is being approved. Now, I also mentioned cramming down and cramming up, and that is potentially the greatest attraction of the restructuring plan. And what it means is that it prevents one large creditor with no financial downside coming from this proposal from holding the company to ransom and collapsing the proposal by virtue of their vote. It prevents them from effectively ransoming their position and ransoming the other creditors. So if the company can evidence that any creditor or shareholder is no worse off under this plan than it would be in the next best alternative, even if that stakeholder votes against the plan, the court can still force through the plan on the basis it is just and equitable. So that really helps bring everybody to the table and ensures everybody's being reasonable. So the only plan that we've seen so far is the Virgin case, and that was very dull, very vanilla, with no cramming in any direction, and everybody voted in favour. But of course, it helps to encourage agreement if people know that you've got a revolver on the table which could force through the result, the proposal at court. So are we going to see a lot of these? The current thinking is that they're likely to be very expensive. Don't know exactly how much the Virgin one cost, but we've spoken to law firms who estimate costs of between £100,000 and £200,000. So it's not for SMEs yet, but as the process becomes more well trodden, the costs are likely to come down. So on to the other points in the Corporate Insolvency and Governance Act. Ipso facto rules are aimed at forcing continued supply in an insolvency process. An insolvency process such as liquidation, administration, and the moratorium and restructuring plan that we mentioned earlier. So as a result of this legislation, a supplier cannot refuse to supply goods or services purely because of the company being in an insolvency process. However, in practice, it's going to be hard to enforce, especially given the time pressure of a trading period in insolvency. Unless a supplier is contractually required to deliver a specific quantity of product on a specific date, in practice, they're likely to be able to give a variety of reasons for being unable to meet ad hoc orders on time. So while this legislation will be helpful to insolvency practitioners, it's not watertight, and the need to reach deals with canny, awkward suppliers is likely to continue. So the next step on this slide is suspension of wrongful trading. It's already extremely difficult to prove wrongful trading without this legislation, and this act makes it even harder. However, there's still significant risk to directors, even ignoring wrongful trading during this time. Directors who act without due care can still be pursued for transactions at undervalue, misfeasance, preference, can be banned for 15 years and subjected to compensation orders by the Insolvency Service, and may also suffer personal liability to HMRC for unpaid company taxes. And as far as I can tell, none of that's affected by this legislation. So directors really cannot afford to be complacent at this time. So on the next slide, we look at the impact to date of SEGA. So the moratorium really has had minimal impact so far. There's only been 2 of them so far, and one of those failed and entered administration. So not an overly wonderful start, but in reality, it is potentially a very useful mechanism which an insolvency practitioner can build into contingency planning as a fallback option if the protection might be needed in the build-up to a restructuring plan, or more likely a consensual agreement or company voluntary arrangement. It's one to have in the back pocket, but due to the severe consequences on creditors if the moratorium fails, it needs to be very well planned and well funded by a sensible IP. The restructuring plan, Virgin is the only example so far. It's been successful, which is great. It was a very simple restructuring plan from what we know. There were rumours that a well-known pizza chain was considering a restructuring plan but opted for a CVA. It's probably not going to become relevant to mid-market companies for at least another 12 months or so until it's more tried and tested with clear precedents and therefore greater visibility over the cost. As I mentioned, ipso facto, still early days, not many examples, but likely to be useful leverage for IPs. And in terms of the temporary provisions, the restrictions on winding ups, where COVID-19 may have had an influence, that's had a huge impact, we think. In August 20, we saw that there was a 67% year-on-year reduction in compulsory liquidations. But the big question is, has this really just succeeded in kicking the can down the road to October? And we'll wait and see. Rumour has it that that these restrictions actually might be extended out to March next year, but we'll wait and see on that front. Atradius, who's a global credit insurance and debt collection group, they're forecasting overall insolvencies for 2020 to be 27% higher by December this year. So notwithstanding the fall in August, to reach those heights by the end of the year suggests that they envisage a lot of distressed activity over the coming months. So finally on this slide, it's unclear how the trading provisions have impacted behaviour, but hopefully directors are avoiding complacency. As mentioned earlier, there's a huge amount of bear traps out there for complacent directors, so planning remains absolutely key to avoiding personal liability. So the next slide talks about the Crown preferential status, HMRC preferential status, that's put in by the Finance Act and is effective from the 1st of December. Many people, including myself, are very surprised that this is going through at a time like this. But from the 1st of December, HMRC will become a preferential creditor in respect of VAT arrears, PAYE arrears, and employees' national insurance contributions. It will remain unsecured for the other liabilities that you see there. So on the next slide, you can see the order of priority, and you can see that HMRC for those liabilities have moved from position 6 up to being 3rd in the priority list, just behind employees' preferential claims. And that means that HMRC will effectively have to be paid in full for those liabilities before floating charge and unsecured trade creditors can expect to see a penny. The floating charge creditors actually suffered a double hit this year because the prescribed part has been increased by £200,000 to £800,000. And basically, that's a slug of realisations that get taken out of floating charge assets and are only used for unsecured creditors and therefore are not available to lenders. So on the next slide, we look at the impact of this status. I'm sorry to say it's a little depressing, especially given the huge amounts of HMRC debt, particularly VAT, which is going to be rolled into next year. So the lower recovery for lenders increases their risk and it's therefore likely to increase borrowing costs and reduce the availability of floating charge funding. So UK Finance, who represents 250 funders, estimates that at least £1 billion worth of floating charge finance will be removed from the lending market. Not the greatest of times to be doing that. The deterioration in recoveries to lenders from clients with HMRC debt may also lead to lenders triggering insolvencies earlier to avoid the accumulation of HMRC debt in those companies. It may also mean that lenders with highly distressed clients at the moment might look to trigger an insolvency before the legislation comes into force on the 1st of December, because it's only really forward-looking. There will obviously be a reduction in return for creditors. Exactly how much, we're not sure. And currently, the impact on CVAs, it's currently possible to compromise amounts due to HMRC in a process called a company voluntary arrangement. But that will no longer be possible from the 1st of December. That means the CVA will become a slightly less effective rescue mechanism, and it will require the specific consent of HMRC for any compromise of their debt. And finally on this slide, a lot will depend on HMRC's stance. If they feel that they're in a stronger position on the failure of a business, one might hope that they may be prepared to offer a little greater flexibility and accept a little more risk than they currently do when it comes to time to pay agreements and similar deals with creditors. And that would obviously improve the prospect of turning around distressed companies, but only time will tell on that front. So the final subject I wanted to touch on is directors' personal liabilities to HMRC. It snuck in under the radar in the Finance Act and became effective this year. In a nutshell, directors, shadow directors and shareholders who have previously been involved with trading insolvent entities can be hit with a joint liability notice from HMRC, meaning they will be personally liable for HMRC debt covering the previous 5-year period. So in order to be hit by a joint liability notice, they need to have been involved with at least 2 insolvent companies and a third company which is either insolvent or likely to become so. So clearly the huge amounts of unpaid tax, particularly VAT liabilities, which have accumulated over the past 6 months, and the resulting increased risk to directors of being personally liable for these amounts due to this legislation, means that directors should now be more aware than ever of the need to get insolvency and contingency planning advice as soon as they become concerned about their ability to trade. So the last slide just is a summary of the entire of the last 6 months' movements. We've got minimal impact from SEGA 2020, other than the temporary restrictions on winding up that we mentioned. They're currently due to expire at the end of September, but as I say, there is rumour that that might be extended out to early next year. Lenders' lives, though, have been complicated quite significantly by the moratorium legislation, by HMRC preference, by an increase in the prescribed part, and by general COVID-19 pressures. So it means that lenders and their clients keeping close and maintaining excellent communication and ensuring that they're properly advised is now more important than ever. So we mentioned the personal risk to directors being significantly heightened for various reasons. So again, they need to ensure that they've got excellent visibility over their accounts and forecasts. And HMRC's position has been significantly strengthened, and it will be interesting to see how they use their new influence, because that's going to have a major impact on a very large number of distressed businesses in 2021. So finally, given the uncertainty and distress which will undoubtedly be seen over the coming 12 to 18 months, the ability of companies to navigate through this period will be dependent on excellent communication with key stakeholders, clear planning to identify bumps in the road and how to handle them, and getting the right advice as early as possible if insolvency becomes a concern. So thank you very much for joining us and listening through all of that. And I think I'm passing back to possibly Justin for questions.
So yeah, we've got a few questions through, but please do keep sending them because we've got about 15 minutes to try and chat through these. So yeah, any further questions, please chuck them in the Q&A box and I'll pick them up. First question I have is from Natalie, and it's for you, James Tetley. Is there now the possibility to complete estimated loss carryback claims before the accounts and corporate tax returns for the period have been completed?
Thanks, Justin. Yeah, our understanding at the moment is HMRC aren't accepting those. They're still holding fast and do expect to see signed accounts and finalised tax returns all submitted through the usual electronic processes before they'll accept that claim. So I think best advice at the moment is to try and accelerate that compliance process as best businesses can.
Thank you very much. And then the second question here, this one's for you, Andrew. Do the IR35 rules apply to contractors that are remote working overseas?
Good question. There's a couple of points to this. One, if the intermediary, so if the contractor's intermediary is registered overseas, offshore working rules apply. So they are separate to the R35 rules. They're in existence now, and it's a piece of legislation that ultimately brings the client, UK client, into the pay-as-you-earn national insurance charge. So that's one to look out for. If it is a UK intermediary, registered intermediary, and just because of the pandemic, the individuals have decided to remote work overseas, and that may continue beyond April 2021, then the R35 rules will apply, so clients will still have to do the mandatory status assessment. If it's determined that the contractors are deemed employees, and ordinarily they would then have to be put on payroll with tax and national insurance deducted, they would still have to be put on payroll, but they could potentially apply for an NT tax code if the individuals are not going to be coming back to the UK and are all going to do their project remote working overseas. So yeah, a couple of things to think about, but if it's UK limited company or intermediary registered, it will apply.
Okay, great, thanks for that. Question here from Nicola. It says, James Guy, what do you think the challenges are for accepting a role as a monitor?
I think sorry, James speaking, I think the key challenge is that you're really going to have done a huge amount of planning to make sure you understand the business model and exactly how much in funding it needs to successfully get through the monitoring period, and also to be very confident that you'll be able to reach a successful agreement with creditors, because you are stating a belief that not just that it's likely, but a belief that you'll reach a successful outcome and save the business. So that's quite onerous, and I think parties, IPs that do that frivolously can expect to be quite strongly sanctioned by their governing bodies.
Great, thanks, James. And then I've got another question for you here. What's your view on the likely attitude of HMRC to time to pay plans once they have become a preferential creditor?
I think it's very hard to predict. With time to pay plans, a large part of it sounds strange to say, but is being able to instill confidence in the particular individual you're talking to at the time. There's not always a set policy. If HMRC are taking the approach that if there's any risk of diminishing their return, then actually it could make them more aggressive, because the risk of floating charge assets diminishing during that period could quite conceivably be fairly high. But if there is an edict within HMRC that says actually we're now in a stronger position than we were when we were unsecured creditors, then they should be more flexible, because there's no doubt that this will put them in a stronger position of recovery compared to prior to this legislation, and therefore they should be able to afford to show a little bit more flexibility. But it depends whether or not that edict will come down from on high within HMRC. So unfortunately for now, we've not received messaging on that, and it's a little unpredictable.
Thank you very much for that, James. I think we're going to go back to you now, Andrew. What are you recommending businesses practically do to prepare for IR35?
Yeah, so a couple of things. One, they really need to understand the stakeholders within their companies, in their businesses, who are going to be relevant to ensuring all aspects of the compliance are identified and considered. That's the HR teams, legal teams if they have legal, if not, their legal advisors. Payroll is going to be a big one. People forget about them, but don't need them to last. But equally the board, because this is an area which is going to need some real traction. And if the board can get involved and make it work, and obviously hopefully get a bit more traction down into the teams. From a practical point of view, if they have many contractors, they can't necessarily look at them all at the same time. So to categorise their contractors into business critical, to transient, and in the middle the ones that are nice to have, and work through. And you've still got time, 7 months. Work through the categories, make sure by April all have been considered. Those that are transient that may not be here, they may not even need to consider, but particularly the business critical, how are they going to approach them, how are they going to deal with them if they're identified as deemed employees.
Excellent, thank you. And the last question here, where do you start on negotiating that time to pay, i.e. who do you call? I guess that's for you, James Hawksworth. James, are you still with us?
Sorry, yeah, no, I'm still here. I was on mute. Sorry. There is a helpline that you can call if you're wanting to negotiate a time to pay, if you just Google that, it's 0241 222. So that's a good point to start. But you should really be maintaining a dialogue with your regular HMRC contact just to keep them aware of what is going on. And the approach of HMRC moment is they are very supportive. So the most important thing approaching HMRC time to pay is that you've prepared your forecast and you can talk to them credibly. The last thing HMRC want, what they hate, is if they feel like it's being used as a bank. But if they can see that you've given some forethought to your position, that you're approaching them as a last resort, then you stand a good chance of getting it through. If the numbers are a little higher, then it's best to get in touch with someone like us at RSM, and we can help you structure a proposal to HMRC, which will make the chances of getting it through.
Thanks, James. Can you just repeat that telephone number you gave out there, could you?
Yeah, sure. It's 0800 024 1222.
Perfect, thank you. Oh, and James Tetley, I think you've got something to add as well.
Yeah, I'd echo the points that James Hawksworth made. What typically happens is once you get through to that helpline, again, depending on the size of the liability, a specific contact will come back to you, and then you typically get into dialogue through emails where you will put a proposal to them. They will then talk to their senior management teams to assess whether that's acceptable. At the moment, it's a careful balance. They do expect to see forecasts that are carefully and well thought out, but they're equally particularly keen to be overwhelmed with information. So what I've typically found is that balance is to show that there is modelling and there is a forecast behind the scenes, but certainly in the first instance, they may not want to see that in its entirety.
Excellent, thank you for that, James's. Well, unless we have any last questions or anything that any of our presenters would like to add, I think that brings us to the end of today's session. Thank you all for joining us. Please, if you do think of any questions for any of the panelists or on any matters, then please do send either me or any of us an email, and we'll be more than happy to get back to you or give us a call. And similarly, if you have any ideas for future topics or any feedback you'd like to give, then again, please do get in touch. Thank you very much, and I'll speak to you soon.